Hey everyone, it's Mike and welcome to lesson number 3, point of control as support and resistance. And this is one of the main ways that people use point of control. It's an obvious support and resistance level, I think, for most people. And once you understand it, I think it'll be very, very clear to you going forward. But before I begin, brief disclaimer, this presentation is for educational and informational purposes only, should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Alright, so lesson 3, point of control as support or resistance. Now, in order to make consistent profits in trading, it's important to understand how supply and demand works. And oftentimes people associate supply and demand with support and resistance. Now, volume is going to confirm support or resistance in the market, not price. And most people that trade based on price, they fall into this false belief that when price trades there, automatically that's got to be a support or resistance level. Not necessarily. Oftentimes you see traders draw their support and resistance lines on a chart based on price levels. And this is a result of treating all prices the same. Not all prices are the same. You know, if you trade, say in the S&Ps, right? If the market has been selling off and we trade 2,700, we touch it, but it only trades, 100 contracts versus it trades 2,000 contracts. Which do you think is going to be more important in the overall analysis of the market? Well, the 2,000 contracts is going to be more important than your average 200 contracts. Now, point of control gives you natural real-time market-generated support and resistance level, which is going to be much more sensible than other forms of defining support and resistance. Now, I got this off the internet. I stamped this one fake news, how to find horizontal support and resistance levels on your chart. Well, if price has been going down for some time and it hits a price level and bounces up from there, that's support level. Not necessarily. If price goes up, hits a price level or zone where it cannot continue upward any further, then reverses, that's a resistance level. When price heads back to support or resistance levels, you should expect that it will get rejected from that level again. The use of reversal candlestick trading on support resistance levels becomes very handy in these cases. Wow, how nice and neat. That's almost like a textbook example. Textbook example for doctors. You cut open the body and you take the heart out. What they don't really tell you is in reality, it's not nice and neat like that. If you're a battlefield doctor, if you're out there in triage dealing with people, you got all sorts of things to deal with. But if you're in a sterile environment, operating where you got all the tools at your disposal, yeah, it's nice and easy. And unfortunately, trading is more like triage than operating in the operating room. And just because price has been going down for some time and hits a price level and bounces up from there, that's not automatically a support level. It can be price rejection, just as if price goes up and can't continue upward any further and reverses, that's not a resistance level, that's price rejection. Or if selling comes in, then that's resistance, right? Just because it touches a level doesn't automatically make it support or resistance. And usually what follows that nice neat explanation there is a chart like this, where market goes up, comes down, goes up, goes down, goes up, goes down, goes back up, and finally breaks through. Like, wow, it's so nice and neat, but that's not what charts look like. Charts oftentimes are all over the place. The angles are wrong. It comes in rounding bottom, but all of a sudden they just assume more buyers than sellers here. Well, for price to go up, you're going to have more aggressive buyers than aggressive sellers. You don't have more buyers than sellers. That's ridiculous. For every buyer, there's going to be a seller. But, when people see these charts, I see this a lot online. Beginning traders, they have these nice charts, like they draw it out like this. Oh yeah, this is support resistance. No, if you know what's going on, right? Because if this is resistance forever, it's going to hold. Well, if you're watching the volume, you're going to know that it's going to break through there. You're going to know if it's going to hold here. And what I'm going to show you later is, as soon as A is hit, you want to know that that's resistance. You don't want to come back up and trade C. Okay, now we got resistance. Now I can get short, and you get short somewhere in the middle. Where's your target down here at D? Would you rather get short as soon as you hit this red line, or somewhere in the middle? Right? You want to get short up here, and that's what point of control is going to allow you to do. It's going to allow you to determine that, hey, when we hit A, we've got resistance, or when we hit B, we've got support. So you could be waiting at point C, D, E, or F for the times that it comes back here. And if it's going to keep going up like it does here at this last bar, you want to know, right? You want to know what's going on in the volume, right? And point of control is going to help you determine if we're going to keep going higher or not. So really, what is support and resistance? Well, support occurs when price gets low and buyers step in to the market and start buying in a bid to support the market from going lower. You know, all too often, right? Markets don't just pull back right to the exact same level 3 times. You know, it pulls back a little bit through the level, or 1 or 2 ticks above the level. You know, it's not, the market's not pretty like this. Okay, that's just the reality of it. And why is because, you know, buyers are coming in because they're sensing as we get down here to D, they're going to see, are we going to break B? Are we going to break this level? Okay, now I'm attracted. I'm going to come in and start buying. Then we hit it twice. Then the time you start coming down to F, people are already thinking, hey, you know what? There's buying in here. So they're going to preempt it, and they're going to be buying it a few ticks above that level, knowing that there's already support there that the market can go up, right? So it's not nice and neat where it trades right down to the level like that. We all wish it was, but the reality is it's not. You know, resistance occurs just the same. You know, when prices reach a high level and sellers step into the market and start selling their excess supplies at profitable prices because they view the market at the current prices as being above value. Right here's, you know, maybe they got value somewhere in here in between, you know, in between the red and the green line, somewhere in there. So when price gets up here, that's why they're selling. You know, but it's going to mean something else if, you know, if volume is lighter at E than it was at C, and then we come back up here and test it and keep going up, right? You want to know what's going to happen here. And again, you know, understanding point of control and understanding volume is going to help you determine if we're going to keep going up or we're just going to keep going trading in a range. You know, if you're coming up in here and you're seeing actual volume in the bar getting stronger than it was earlier, you know that this move has got something to it. Now remember, you know, price action, I mentioned this earlier, price action is an advertising mechanism to draw market participants into the market. The best way to attract buyers is low prices. Best way to attract sellers is high prices. You know, that's why you go to Costco, is because the prices are low, right? You're not going to go to the store and buy your groceries that has the highest prices thinking that, well, it must be better. It's the exact same thing. You're going to go shop at Walmart. You're going to shop at Target because you're buying, you know, the same toilet paper at a lower price than you're buying it at the regular grocery store. And traders see areas where prices come back and test the level and then proclaim that, oh, this area is support or resistance. You know, like here, right? We came back here. That's automatically resistance. That's automatically support. No. You know, point of control allows you to make that determination as soon as price trades there the first time. You know, as soon as you trade A, maybe there's something in the point of control that tells you this is resistance so that you can be waiting when it trades C, when it's trading E. Maybe there's something when you hit point B in the order flow in point of control specifically telling you there's support here so that when it comes down towards D, you can be buyer again to trade it back up to E. You know, that's where point of control, the power of point of control is. So in other words, you're not waiting for the market to come back for confirmation before taking a trade. If you can make the determination that an area is support or resistance the first time it trades in that area, you can take advantage of the next time it trades there. You know, I'm so frustrated sometimes dealing with traders. Like, okay, you based on point of control, you know there's heavy volume up here. You know there's active selling going on up here. Why wait for a C to confirm it before you get short? You're getting short down here. No, if you're going to trade back up here, you're going to look for that heavy volume to still be there. Okay, it's not until that heavy volume dries up and finally dissipates that it keeps going up. But if that heavy volume is still there, you want to be, that's the area you want to get short. You don't want to wait for it to trade up here and okay, then start moving down. Well, okay, well, we had heavy volume here just as we had here earlier. No, that's where you're getting short rather than waiting for the market to make that move and then you get short. But, you know, a lot of traders, you know, they want confirmation. A lot of new traders don't want to be wrong. They don't want to think that, oh my gosh, I don't want to lose money in the market. Well, not every trade is going to be a winner. I mean, that's just the pure reality of it. And you know, sometimes you have to anticipate. I'm not saying you have to forecast the saying, oh, you know, we can get up here. It's just simple. Okay, I had strong selling here. Well, I'm going to step here. It's just like walking on ice, right? If you have a frozen lake behind you, where are you going to walk? You're going to walk where the strongest points are, right? And if you know point B is support there, next time you come back down there, you're still looking for that support. Still looking for that support, right? You're going to step in the same spot where there was strong ice. So what's wrong with this chart? Well, I see you got minor resistance, strong support, minor resistance, minor support, minor support. All too often I see people posting charts like this. Okay, well, why is this minor support here? What about this support down here? How come you guys don't have that listed? What about this here, the one that failed here? Up here. Why don't you have anything here? They like to just draw it where it suits their narrative. Where it just comes in here. Well, this has got to be strong support because it hit this price level twice. Why is this one strong support and this is just minor resistance? Why? Because it's not exactly at the same level? I don't know. They don't really get into it. Major resistance because it tested it many times. 1, 2, 3, 4. Well, here it's poking up through. What's the difference here? Well, it tested it 3 times and another 4th time, so it must be strong. Here it only tested it twice. It got it as strong. Here it tested, I don't know why they just drew this line here. I don't know why they didn't draw a line here and call this some support level or this some resistance level. This right here is the exact same thing as you had here. Maybe they don't want to show too many times where it failed. And all too often, that's what people do is they just say, well, price traded here, so I got resistance, support here because price traded here, then went higher. Without any logic behind it. Now, to understand how point of control is going to act as support or resistance, you have to understand the different types of traders in the market. Again, this is an order flow thing. You have aggressive buyers, the traders who buy the offer, they buy at the market. Aggressive sellers, traders who sell the bid, they sell at the market. And who do aggressive traders trade against? They trade against the passive traders. Passive buyers are traders who work a limit order on or below the current bid, or passive sellers work limit orders on or above the current offer. And passive buyers, passive sellers are the ones that provide support or resistance. Right? It's the passive buyer that's sitting there on the bid that aggressive seller sells into. Right? The passive seller is there on the offer that the aggressive buyer buys from. Okay? And when price hits a high level, that's when the passive sellers are attracted to the market. It's not attracting necessarily the aggressive sellers. It does, but what's oftentimes stopping the move is the big passive sellers on the upside, the big passive buyers on the downside. That's your support and resistance. The passive buyers is your support, the passive sellers is your resistance. And sitting on the bid and absorbing all the aggressive trading, all the aggressive selling that's going on is until they give up is what's going to cause the market to turn, because when you don't have the aggressive sellers, right? If you have a big passive bid, aggressive sellers keep selling, and then finally they're like, geez, you can't get past this bid. They give up, and what happens is price, they start covering their shorts, and the market starts rallying, just as the big passive offers that are up there, right? As you see, like for example, S&P has been making new highs all year long. Recently we've sold off, but as you're coming up to new highs, you see a lot of offers up there, right? It's chewing through a lot of passive selling, and it's those offers that people are just happy to sit there, right? And as the buyers keep buying, eventually, sometimes they just run out of bullets, right? They got no more. They're like, okay, I can't buy anymore. I'm full up, and all of a sudden, the market starts ticking down. Then all these people that were late to the party, the late buyers, say, oh my gosh, the market's starting to tick down. The weak longs, they start getting out. They start selling their position, and the market starts. They turn from aggressive buyers to aggressive sellers, and the market starts selling off. And perfect example, right? This is E-minis. It's a 5-minute chart. Look at the point of control down here. I scrunched the numbers because it's a little hard to see because it's quite a lot of space here. But point of control is down here. It's telling you that the most volume in the bar at a price level is down here, just off this low. Okay, and you can sort of see how it's sort of, it's almost like a down arrow here. Actually, this is kind of straight, and then you got heavy volume both sides, and it sort of decreases as you get down to the bottom. But this is important information down here. It's telling me that as we hit this low of the day, you got heavy volume, right? You got 4 digits, 1,000, 1,000, 1,600, whatever over here, Normally you're getting, a couple hundred on each side, but it's coming down here. There's strong passive buyers. What happened is the market poked down here. Okay. Traders were alerted to this. Market spiked back up, but they're like, hey, you know what? That's a great buying opportunity. So the second time it came down here, they're there waiting with their bids to absorb it all, and this market is 60, we'll call it 67 3/4 at 68. The aggressive selling is there, and it's met with aggressive buying as well as strong passive buying. So support and resistance, it's interesting because I don't classify myself as an academic or anything like that, but I think it could be linked to the laws of supply and demand. It is support and resistance, but I think what you could also link it to is Newton's laws of motion, most notably law number 3. For every action, there's an equal and opposite reaction. For example, when aggressive buyers move prices higher, they're met by passive sellers who eventually stop the move up. Then aggressive sellers start moving prices lower by selling to the passive buyers that are bidding the market up. What's happening is the prices move higher on aggressive buying, that buying attracts both passive and aggressive sellers to the market. And what I mean is, as the market is moving higher, let's take a look here. As it's going higher, people are bidding up the market, right? They're bidding up the market as well as lifting the offer. Finally, it gets to a level where there's strong passive buyers, but at that point, you also have aggressive sellers coming in. People realizing, hey, this is a good selling opportunity. I don't want to miss this, and they start selling into the bid, and then the market starts selling off again. Just as down here, you had the market selling off, you had passive buyers in here, and then all of a sudden you get down here, buyers, not just the passive buyers that are sitting here absorbing all the selling, other buyers are being attracted to the market and thinking, hey, you know what, this is a good buying opportunity. I'm willing to scoop up everything that everyone's got to sell as well. They're aggressively buying these offers, and the market moves back up. Here's a good example, right? Market's moving up. Look, you get up to this bar up here, point of control right up here, right off the high. Look at the volumes up here. 1135, 2000, 600, 1058. So market's going higher, bid right here. You have strong aggressive selling. It's bid here, 600, strong aggressive selling into that. I mean, normally look at the volumes up here, 200, 126, 173, 385, 400, 150, 600, 120, 73, 1953. You get up here, people are getting excited at these high prices. They're hey, I don't want to miss the train, fear of missing out. Get in, and then people start selling to those bidders, sort of those hungry hippos. Everyone that's trying to jump, bid it up, are met with passive sellers up here. At the same time, once they chew up all the passive sellers, the aggressive sellers are just sitting right behind the passive sellers and hit those bids. That's why you got the volume up there. Right? The point is the volume is up here, not down here in the middle where normally you would expect it on average, right? Remember, think of volume distribution, right? Normally you'd have the volume somewhere in the middle of the bar. A lot of these bars, volumes in the middle, volumes in the middle, volumes in the middle, volumes in the middle, but when it appears at the top of a bar, especially on a bar that turns down, that's telling you that the sellers came in and hit all those bids, hit all those aggressive buyers that turned the market bid. Everyone was buying it here. They turned it bid even, and then those aggressive buyers became passive buyers, and then the aggressive sellers sold into them, and then the market sold off a bit before making a move higher. Now, in a previous lesson, I explained how some software allows you to view the second and third levels of point of control. Now, an observation that we have made is stacked point of controls act as support and resistance as well. And why? Is because it's a pocket of heavy volume. The unique thing about a stacked point of control is it's hidden from those that don't use order flow analysis. Point of control obviously is hidden from people that don't use order flow analysis, and I think to a certain extent stacked point of control is hidden to a lot of people because they don't use it, and they're quite happy with point of control. But traders using price action are missing out on a very important part of market analysis, and that's the volume. And when you get these stacked, right, think about it again as a volume profile. Normally, the volume distribution rather, normally the heavy volume should be centered towards the middle of the bar. But when it appears up near the top of a bar, of a down bar, that's telling you heavy volume is occurring up there. Just as if it's at the bottom of a green bar, market sold off, got a swing low, it's met with strong supportive buying down here, and the market moved up. Just like here, market's moving up, pulls back a little bit, you got some strong passive buying, which turned into aggressive buying, and then turned into a stacked imbalance here. You see the aggressive buyers just keep buying the market up, and it moves up, but then it stops up here, and then it drops down again. You know, just like here is a more clear example. I mean, look at this, almost at each turning point here, right at the bottom, here, right at the top, here, just right near the top. These are in the middle. This is where you would normally expect it. That's where the normal volume distribution should be, in the middle. It's when it appears near the top of a down bar or near the bottom of an up bar. That's when it's telling you, hey, there's supportive buying or there's resistance selling up in here. To act on it. Not every bar is going to tell you something unique, special about the order flow. It's those bars that do tell you, that give you the opportunity to make some good trades. So this concludes lesson number 3. In the next lesson, I'm going to discuss how to use point of control as confirmation with what's happening in the market. So I'll see you all on the next lesson. Bye-bye.